All right, today we are cracking open the case file on one of the biggest names on Wall Street, Morgan Stanley. We're going to go beyond the polished ads and the official company line to figure out what is really going on inside this financial giant. Let's get into it.
You see, on the surface, they project this image of being completely untouchable, the best in the business. But with any institution this big and this powerful, there's always the story they want you to believe. And then there's what's actually happening behind the closed doors of the trading floor. And our job today is to find that truth. So, this is the face they show the world. A sophisticated, global powerhouse. I mean, for nearly a century now, they have painstakingly built this reputation as a true pillar of the financial world. They sell prestige, they sell stability, and maybe most importantly, they sell trust.
And this right here, this is their mantra. It's at the core of their whole identity. First-class business in a first-class way. It's a promise of excellence, of integrity. It sounds great, right? But as we're about to see, sometimes the promise and the reality, well, they don't quite line up. But before we start digging, you have to appreciate the sheer size of this thing. We're talking about 80,000 employees scattered across 42 countries. And everything they do gets funneled into these three main buckets. Institutional securities, that's your high-stakes investment banking, your trading. Then you've got wealth management, which handles money for the super rich. And finally, investment management, which deals with huge funds. Now, remember these three divisions because they are the key to understanding this entire story.
You know, every powerful company has a story about a moment when it all almost came crashing down. For Morgan Stanley, that moment was the 2008 financial crisis. And the story of how they survived? It's honestly one of the wildest tales in modern finance. It was a real nail-biter. So let's set the scene. Picture it. It's the fall of 2008. Lehman Brothers has just vaporized. The entire global financial system is in an absolute freefall. Nobody trusts anybody, credit has frozen solid, and every single major bank, Morgan Stanley included, is under a microscope. And for the first time in a long, long time, this was a real question. Could one of these titans actually go under? The market was basically betting on it. Their stock price was in a nosedive. The firm was facing a complete crisis of confidence that was threatening to just pull them down into the abyss. The clock was ticking, loud. And this is the number that saved them, $9 billion. At the very last second, a lifeline appeared, all the way from Japan's biggest bank, Mitsubishi UFJ Financial Group, or MUFG. They swooped in and agreed to buy a huge chunk of the firm, a massive show of support when Morgan Stanley desperately needed it. Okay, now here is where the story goes from a financial drama to something straight out of a Hollywood movie. The money had to get there before the US markets opened, otherwise it would have been game over. The problem? It was a bank holiday. The wire systems were all down. So what did they do? MUFG wrote a physical paper check for $9 billion. I mean, can you even imagine? An old school solution to a completely modern meltdown, and that piece of paper literally saved the company. So after a near-death experience like that, Morgan Stanley knew things had to change. They couldn't be that vulnerable ever again. So they spent the next decade totally re-engineering their business from the ground up. So how does this new, souped-up money machine actually work? Let's pop the hood. The secret sauce to their big comeback is this strategy they call the integrated firm. And the best way to think about it is like a giant flywheel. So, step one, it all starts with their wealth management arm, which pulls in trillions of dollars in client money. That money then creates this steady, predictable river of fees, which is step two. But here's the really brilliant part, step three. All those rich clients and all that capital becomes the fuel for their high-octane institutional securities division to go out and land massive, high-profit deals. Each part of the machine feeds the next, making the whole thing spin faster and faster. And hey, don't just take my word for it. The proof is right here in the numbers. Just look at this revenue breakdown. The business is now split almost perfectly down the middle. You've got the risky but super profitable institutional side, and right next to it, the stable, boring but reliable wealth management side. That is not an accident, folks. That is a fortress designed to survive any storm. But they didn't just stop there. Oh no. To really supercharge this flywheel, the CEO at the time, James Gorman, went on a shopping spree and made two monster acquisitions that completely changed the company's DNA. First, they spent an eye-watering $13 billion on E-Trade. And this was a genius move. It wasn't just about buying a brokerage, it was about building a giant funnel to suck in millions of new, younger investors who, down the road, could be converted into high-paying wealth management clients. Then, they dropped another $7 billion on an asset manager called Eaton Vance, and with that one deal, they doubled the amount of money they managed to over $1 trillion, basically pouring concrete over the foundation of that stable, fee-based business. Two massive bets on stability. So, the company survived the crisis, they rebuilt themselves into a fortress, and the official story is one of brilliant strategy. But this is where our investigation takes a sharp turn. Because while all of this was happening out in the open, a very different story was playing out behind the scenes.
And this is where the feds enter the picture. Investigators from the SEC and the Department of Justice started sniffing around, and they uncovered something that was rotten to the core inside one of the firm's most elite trading desks. The accusation? Traders were leaking confidential, market-moving information about huge stock sales called block trades. So here's how the scheme worked. According to the government, a Morgan Stanley trader would get a secret heads-up call to one of their favorite hedge fund buddies, telling them a huge sale was about to happen. Armed with that inside scoop, the hedge fund could pre-position themselves by shorting the stock, basically betting it would go down. And when the giant sale finally hit the market, the price would drop and the hedge fund would make a fortune. And here's the kicker. This also made the deal less risky for Morgan Stanley. The only people who lost out? Their own clients. So what was the price for this betrayal of trust? A cool $250 million. Morgan Stanley had to fork over $249 million to settle the fraud charges. That is a massive penalty for what regulators called a complete failure to protect their clients.
But what was Morgan Stanley's official story? You guessed it. They blamed it all on a couple of bad apples who broke the rules. It's the classic defense. But regulators, they weren't buying it for a second. They pointed to a much bigger, systemic problem, a culture where the firm's own rules were just ignored. A huge gap between the excuse and the reality.
And our investigation found that this block trading scandal wasn't just a one-off. Not even close. Right now, the firm is staring down the barrel of a massive multi-agency investigation into its anti-money laundering controls. We're talking the SEC, the Treasury, the Fed, you name it. They're all digging into how Morgan Stanley vets its clients to make sure it's not being used as a laundromat for dirty money. The heat is definitely still on.
So, after digging through all the evidence, all the files, what's the final verdict here? Well, our investigation has uncovered two very, very different versions of the same company. And this slide really lays the whole case bare. On one side, you have that carefully polished public image, the first-class motto, the brilliant business strategy, all the talk about integrity. And on the other side, you have the hidden reality that we just dug up. A company that's constantly under investigation, paying hundreds of millions in fraud settlements, and getting caught leaking its own clients' data. And so our investigation closes with one final big question. The Morgan Stanley files shows us a company that's both a brilliant strategist and a documented rule breaker. It really forces us to ask a bigger question about Wall Street itself. In this relentless, never-ending chase for profit, is it even possible to always play by the rules? Or is there always a hidden, darker side to the story? That is for you to decide.